Before we get started, just a reminder for those who have the applied level. I have posted the ABR short defense last week. It's almost 4 hours long. I also added the two-part series I had done a few years back on understanding how ABR makes money. So there's ABR part 1 and 2. I moved it into this folder along with the ABR short defense. So this is the financials sector of the sector studies. You can see 13 hours, almost 14 hours long. You have a breakdown of the sector, a breakdown of agency, and then a review of its 10Q, a 5-part series on understanding banks, and then ABR. Also a reminder, the price increase is December 1st. It is now November 26th. So if you want the applied series, the 320 price ends November 30th. It then goes to 440 because there's so much more content in there, and that will be in place for the next year. And finally, it is the last Sunday of the month, so if you click on live sessions, you see the applied series Q&A on the side. If you click on that, it will tell you that next live sessions are today, noon to 1:30 New York time or Toronto time, and another one this evening from 9 p.m. to 10:30. So for the applied level subscribers, if you have any questions, and I'm sure there must be some questions about the ABR short defense, you can ask me during those sessions. Okay, let's have a look at rates week over week. And I gotta say, this has been probably for quite some time one of the most boring week over weeks for rate changes. Look at them all increased except at the 20-year, but all of them increased, but none of them double digits, 2, 3, 4 basis points. That's normal. So we may be at the point where not only is the Fed on hold, but the high volatility that we've seen over the last year in treasuries may be fading away. We may be going back to a low volatile rate regime. The slopes also well behaved. The 2 to the 10, 1 basis point change. The 3-month to the 10-year, 1 basis point change. The Canadian inversions still much deeper than the U.S. inversions. We're still triple digits on the money market to capital market inversion here. The Fed balance sheet, the SOMA running off as expected, down almost $3.5 billion. But look at the balance sheet itself. It is dropping $45 billion for a net drop of 42. Week over week, the balance sheet has been dropping by more than the SOMA. So there is a decrease in the assets held on that side that are outside of what was purchased for quantitative easing. Money market funds, this is surprising me that they're still increasing. I thought especially with the S&P just sitting under the July high, I think we're 40 points away from taking that out, that money would be flowing either into equities or flowing into the capital market from the money market, but nope, increased another 30 billion, and in all categories. Retail up almost 13 billion, institution up 16 billion, and both of them increased their government money market exposure and their prime money market exposure. We're now sitting 17 days away from the next FOMC meeting. Probabilities changed slightly. Still the heavyweight 95.5 on nothing happening, and this is where I am. Going out to June, the probability of at least one rate cut was 82.3. Futures are implying it's now down to 70.8, and that no change is increased from 17.7 up to 26.1. This may be due to University of Michigan numbers that came out showing the long-term inflation expectations had increased. And there is some weight on some increase by June, or at least an increase being in the rates by the June 12th meeting, 3.1% on one up to two rates, 0.1 on the two, and I think that's just a positioning of where the futures closed, that there was some something left over, so it got attributed to the 6%. A week for risk, economic risk. Earnings are pretty much done. I think we got a couple of earnings next week, 4 or 5 companies, but they're pretty much done. U.S. GDP, the second look at U.S. GDP, but the first look at gross national income. So with gross national income, we get corporate profit growth quarter over quarter. We get that in 3 days. PCE in 4 days. And I expect PCE to be consistent with CPI. And in fact, some of the categories in CPI are either not present or present at a lower weight in PCE. And they're the ones that had the highest CPI month over month. So I think PCE will come in fairly benign. For Canada, third quarter GDP is in 4 days. We get monthlies like 2 months delayed, so it's really rear view mirror. So the quarterly is just the sum of all of the monthlies. I don't think there are too many surprises there, but be aware we get that in 4 days. And Canada has a jobs report on December 1st, which is Friday, because the U.S. had a holiday last week. They're not going to be reporting jobs numbers till the 8th. Usually it's the other way around. Usually the U.S. produces numbers on the 1st, even if Friday is the 1st of the month, and Canada usually is a week behind. It's reversed this time. Canada this Friday, U.S. next Friday. For Fed Speak, Tuesday, you have 4, Goolsbee, Waller, Bowman, and Barr. And in case you didn't hear him, he's going to say it again later in the day. Wednesday is Mester, Thursday is Williams, Friday Barr, Goolsbee, and Powell. This is at 11. This will be live. You can go to the FOMC site and you can click on the link to watch it live. So Google FOMC Fed speeches. You'll get a calendar up. Find December 1st. And you'll have a link to watch it live. Spelman College Fireside Chat. So that is a situation in which, he could be asked anything and it's an open answer, not a prepared speech. So it on the calendar has a red bar indicating high priority. Be aware that he is speaking December 1st at 11, but we don't have the jobs numbers from the U.S. that day. We'll only have had corporate profits, gross national income, corporate profits from gross national income. The second look at GDP, I don't know that I would be too concerned about that. That is the third quarter second look. Maybe it gets changed from the 4.9, but usually not much. And the PCE. Effective federal funds rate still sitting at 5.33, so the 12-month lag is 150 basis points. Look at the reverse repo just dropping from 935 billion now down to 865 billion. Another 70 billion out at 1-day SOFR, 5.3. And there is supply of T-bills, and from the 1 month to the 6 month, all the T-bill rates are higher than the 5.3. So why take the 5.3 when you can do better? Real rates and break-even rates following nominal yields changed just a little, but really nothing to talk about there. The bigger story is the drop in volatility that seems to be going on now. We'll see if that continues. Looking at the Fed funds futures, still looking at 100 basis points over the next year when we combine Fed funds futures with the 1 month SOFR forward curve. The futures bottoming out in February still from 5.33 to 5.365. I think this is an anomaly. I think it's I don't think anybody's really expecting much of a change. Same with the probabilities. I think that's just an anomaly of some positioning on the futures curve that created the illusion that perhaps there was some probability there. Going out to June, the implied rate 5.06 up to 5.13, drop of 23.5 basis points from the end of February to June. And going out to September, an increase of 8 in the implied rate, 4.81 to 4.89, implying 24 basis point drop in the third quarter. And the SOFR futures from December 24 to December 23 is negative 92. So attributing 23, or is it 23 to the second quarter, attributing 24 to the third quarter, you have 44.5 in the fourth quarter. Still looks consistent at 4 rate cuts, at least pricing in to the curve 4 rate cuts over the next year. TLT basically flat, opened up here, closed over here, down 0.27. SPY is down, it was up 1%, and implied volatility on TLT continuing to drop. Last week was 34, now 33 on the 13 weeks, 61 down to 53, and 43 down to 32. When we get to SPY, we're going to see the implied volatilities are 0, 0, and 0. In other words, all readings of implied volatility for the last 13, 26, and 52 weeks have been higher. Lowest implied volatility in the last year. Well, if you look at the 52 week at 0%, meaning that we have not seen implied volatility this low. So volatility just seems to be disappearing. It's out of equities, and it is really coming out of treasuries. Mortgage rates continue to drop double digits, 15 basis points week over week, down to 7.29, now down 50 basis points from the high of 7.79 we saw 4 weeks ago. The spread between the 10-year U.S. Treasury and the 30-year fixed rate contracted 12 to 287, and even at 287, that's about 100 basis points higher than its normal range. Let's just jump over to the housing data we got last week. Existing home sales down 4.1%. Mortgage applications up 3%. This is 4 weeks, 5 weeks running that we've had increased mortgage applications. I think it's the highest level of mortgage application activity for 6 weeks now. The drop in existing home sales I thought would be good for housing stocks, but was sort of mixed. So we'll put it to the test on Monday. New home sales for October are out on Monday, with existing home sales down and mortgage applications up. There's less competition for the home builders for sales, so you would think that a positive number here would be consistent. And I thought that that would be priced in here, but we have a mixed reaction across the home builders and almost nothing going on in the ETFs for the sector. For the mortgage REITs, agency, call that flat. Anley down 1.5, and Arbor down another 3, which is, to me, odd that that short report would still have some remnants in the marketplace. It just seems so easy to destroy. Not only that, have a look at Arbor's Form 4s that it's been filing on the day of the short report. The CFO on the 16th bought 7,500 shares, which is just shy of $100,000. On the 21st, bought another 2,500 shares, and the CEO on the 21st and the 24th bought a cumulative total of 35,000 shares. Plus, there were 2 more insiders that had bought shares. If that short report had any truth whatsoever, I mean, you have a CFO that's risking some 120,000 of his own money to get that done, and the CEO adding another 35,000 to his already, I think he has just slightly over 1 million shares, adding more to it. If there was some validity to the short report, if these were insider sales, I would be concerned. But insider buys, not before the report, but after the report, and buying, I don't know what more clear signal you can get that management, the CEO and the CFO, are putting their own money in harm's way. If you think about it that way. I'll after this screen, we'll have a look at the Form 4s. I'll show you where to find them and how to read them. So next week for housing, as I said, Monday, new home sales. Tuesday is the house pricing index and Case-Shiller. Backwards looking, it's for September. And Thursday, pending home sales for October. And for the OAS, continues to be a nothing to see here story. They've contracted. In fact, look at IG sitting at 115 basis points. And where is our high yield? There it is, 390 basis points. All of them have contracted week over week. I'm on Arbor's investor relations page, and at the very top you can see SEC filings. By the way, if you are at any company's investor relations site, you can submit your email address, and then you click on SEC filings and presentations. If it gives you a choice of what you want, click on all of them. And every time an SEC filing is made, you get a notification in your inbox. You don't have to keep checking every single day. Has something been done? Has something been? You'll just get a notification. Click on SEC filings and you'll get a list of all the filings they've done in order, and you can change the filing year and the filing type if you want. You just drop this down: annual filings, quarterly filings. These are changes in beneficial ownership. So November 24th, Form 4, if you just click on the second one, which is the PDF, we see it's Paul. Paul is the CFO. And look down here, A is acquired, D is disposed of. There's an A, 2,500 shares, date of transaction, November 21st at $12.20. The amount of securities beneficially owned, 280,000. So is adding to an already large number, 280,000. Let's have a look at the next one on the list here. And this is Ivan Kaufman. He is the CEO, and we see two acquisitions here: 15,000 on the 21st at 12.23, and on the 24th of November, another 20,000 at $12.15. Total amount owned, 1 million, at least beneficially owned, 1,068,000 shares. And head down here on this one, November 20th. Again, this was after the short report came out. If you click on that, there's the CFO. There's the first purchase made on the 16th, the day the short report came out, at 12.37, 7,500 shares. And if you look at some of the other ones, there was November 9th, insider buying there, November 8th as well, November 2nd, after the earnings had come out. Three of the insiders had bought shares, and then after the short report, there's even more buying of shares. At this point, I think it would be useful to look at three companies' earnings. We're going to look at Home Depot, we're going to look at CAT, and we're going to look at NVIDIA. So let's start with Home Depot. This is the transcript from their earnings call, November 14th, 2023. We'll set the stage here. Sales for the third quarter, $37.7 billion, down 3%, which is $1.2 billion, down 3% from the same period last year. Comp sales declined 3.1% from the same period last year. Comparables are for those stores that were open last year for at least a year versus this year. So if a new store opened in between, it has no comparable. Because it's still ramping up sales. So it's only for stores that have been open for the same period year over year. So comparables declined 3.1% from the same period last year. Taking just the U.S. operations, the U.S. stores had negative comps of 3.5%. Diluted earnings per share, $3.81 in the third quarter, $4.24 in the third quarter last year. Let's break it down. And with Home Depot, you really have to. So it says, sales are down 3%. But is that sales are down 3% because the price of what you sell is down, or because you have less traffic flow? So they do break it apart later in terms of how much of this drop was from the number of transactions they had, and then how much of it was from the average ticket. And then they can adjust for deflation in commodities. So they sell a lot of lumber, which is a commodity. Well, we know lumber prices have dropped a lot year over year. So it could be that you can sell more lumber let's say 10% more lumber year over year, but if lumber prices are 20% down, it will give the illusion that you've had lower sales quarter over quarter. So you do have to later on break it down into the transaction and the ticket size, which they do. With only 1 quarter left in the year, we believe the endpoints of our previous guidance range are no longer likely outcomes. As a result, and as we have announced in this morning's press release, we narrowed our guidance range for fiscal 2023, which means we've lowered the upper end and raised the bottom end. We've narrowed it down. Well, they got the third quarter behind them. There's only 1 more quarter to go. You know 75% of what your range is going to be. This year reflects a period of moderation. It's a nice way to say it, isn't it? Okay, let's break it down here. Turning to our department comparable performance for the third quarter, building materials posted a positive comp, and 7 of our remaining 13 merchandising departments posted positive comps above the company average, including plumbing, appliances, hardware, outdoor garden, millwork, tools, and paint. During the third quarter, our comparable transactions decreased 2.7%. So now we're getting to, okay, you say you're down 3%. How did that break out? 2.7 was fewer transactions. That means fewer people in the store. And the average ticket decreased by 0.3%, which means fewer people in the store. And of those people, they're spending 0.3% less on average. Excluding deflation from core commodities, we experienced comp average ticket growth, primarily driven by demand for new and innovative products. Deflation from core commodity categories negatively impacted our average ticket growth by approximately 60 basis points during the third quarter. So if you control for deflation, the decrease of 0.3, when they say that they had ticket growth, you would add the 60 basis points to that. It looked like it was 0.3 growth. So you still have the problem of 2.7% fewer transactions, not offset by ticket growth, only 0.3 on volume, not price, but on volume. Our average ticket growth by approximately 60 basis points during the third quarter, driven by deflation in lumber and copper. During the third quarter, we continued to see decline in lumber prices relative to a year ago. As an example, on average, framing lumber was approximately $420 per thousand board feet. That's on a spot wholesale price, not what they would sell it for, a spot wholesale price, their input cost. $420 per thousand board feet compared to approximately $545 in the third quarter of 22, representing a decrease of over 20%. So noting deflationary categories, big ticket comparable transactions, or those over 1,000, were down 5.2% compared to the third quarter of last year. We continue to see softer engagement in big ticket discretionary categories like flooring, countertops, and cabinets. This is consistent with 2 companies that I deal with down here. One is a landscaping company, one is a construction company, because I did have some work done again over the summer. Both of them say that business fell off a lot sooner this year than normal and a lot deeper. That usually they have some business that stretches into the fall, and it fell off a lot. Continue to see softer engagement in big ticket discretionary categories like flooring, countertops, and cabinets. However, we saw big ticket strength in pro, heavy categories like roofing, insulation, and portable power. So what is pro? There's the DIY, the do-it-yourselfer, and the pro. And those are their 2 big customer segments. The do-it-yourselfer, you go in on a Saturday, which is a stupid time to go to Home Depot, by the way, and you buy stuff to fix your house and you're going to do it yourself. And then you have the pro, which goes in on a Wednesday afternoon, which is the smart time to go to Home Depot. The pro shows growth. Later on, they do mention that the pro is stronger, or at least has shown a stronger presence in their sales year over year than the do-it-yourselfers. And I think we have our guidance down here. I will comment on guidance for the rest of the year. Have you heard from Ted? With 1 quarter remaining in fiscal 2023, we no longer expect the endpoints of our previous guidance range as likely outcomes, and therefore we are narrowing our guidance for 2023. We expect fiscal 2023 sales and comp sales to decline between 3 and 4%, fiscal 23 over fiscal 22. We are targeting an operating margin of between 14.2 and 14.1 for the year, slightly lower operating margin. Effective tax rate 24.5. Interest expense of approximately $1.8 billion, which is a significant increase if you look at their interest expense over fiscal 2022, a significant increase. We are anticipating between a 9 and 11% decline in diluted earnings per share compared to fiscal 2022. Let's move on to John Deere. But we'll first review what Home Depot tells us. We have a story of commodity deflation, a drop in aggregate demand as evidenced by the transaction volume being lower, and interest rate sensitivity for the categories over 1,000 in the do-it-yourselfer category, which is the household. So let's look at John Deere, 3 segments, and John Deere's interest rate sensitive as well. Production and precision ag, small ag and turf, and construction and forestry. The consumer sits over here, small ag and turf and compact utility. The riding lawnmowers that you see some people drive, that is where the household sits. Let's have a look at their earnings presentation. This is from November 22nd, 2023. And let's look at year over year for the quarter. Net sales and revenues down 1%. If we strip out the financing segment and just look at equipment operations, down 4%, yet was able to squeeze out 5% increase in net income, mostly by management of production costs, and diluted earnings per share up 11%. Let's look at how it got there, and we're not going to break each one down. I just want to point out the change in operating profit from 2022 up to 2023. It breaks it out in terms of the variables that account for the change. There is volume and mix down 622 million. Price makes up 729. So price increases outweighed volume drops. Net sales in the production and precision ag, their first segment, down 6%. There's your production costs, 40 million. Since it's green, it's saying that it added 40 million to the difference between 1.74 billion and 1.836. This is small ag and turf, the second segment. Volume drops at 189 million, but price makes up 168 million, and production costs add 35 million to the operating profit, meaning control of production costs. Net sales down 13%. And this is the outlook for 2024. Not good. US and Canada, large ag, segment 1 expected to be down 10 to 15%. And segment 2, small ag and turf, down 5 to 10%. Europe for both segments down 10%. South America for both segments down 10%. Asia just down moderately. What does that turn into in terms of sales and operating margin? And this also is not very good. Net sales expect to be down 15 to 20%. Not only that, not only lower sales, but lower margins on those sales. Operating margins 26.1 dropping to 23 to 24%. For small ag and turf, sales down 10 to 15% for 2024. And margins also getting hit from 17.7 down to 15 to 16 range. Construction and forestry, sort of the same story here. If we look at volume and mix, didn't really do much, but look what price did. Really increased quite a bit. Net sales up 11%, mostly on price realization. And if we look at the outlook, US and Canada for construction down 5 to 10%. US and Canada compact construction equipment flat to down 5%. Global forestry down 10%. And global road building is flat. That turns into a negative 10% drop in sales, margins from 18.2 to the 17 to 18% range. So we're seeing their outlook for 2024 in a high interest rate environment. And we also have to throw in low commodity prices, especially for wheat, corn, soy, because that's really affecting their first segment. The consumer is affecting some sales in the second segment, especially the riding lawnmowers. The sales of riding lawnmowers correlates very highly with home sales. So the higher the the higher the amount of homes sold each year, new and used, the higher the amount of units they sell, the riding lawnmowers they sell. So a consistent story, I think, with Home Depot. Home Depot seeing deflation in commodity products. They point to lumber and copper. John Deere sees deflation in ag products, pointing to wheat, corn, and soy. And the lower those prices go, the less need there is to expand fields. If you're not expanding fields, you don't need more equipment. And lower volumes because of interest rate sensitivity. Okay, NVIDIA. Let's have a look at its revenue trend. This is the quarterly revenue trend by markets. And let's ignore data centers for now. Let's look at gaming. You go back to Q4 of 2022, 3.4 billion. Q1 of 23, 3.6 billion. Then it really dropped off. It's starting to recover at 2.8 billion, but still below where it was almost 2 years ago. Professional visualization, 416 million, still about 2/3 of where it was 2 years ago. If we look at auto has increased nicely, 125 to 261, but has been sort of trending. It hit 294, 296, and then sort of been trending sideways below that number. And OEM and others from 192 all the way down to 73. So if it were just those four segments we were looking at, it would be a big, it's data centers, and really data centers in the last 3 quarters. So we had, if you look at the revenue trend here, 3.8 billion, 3.8, kind of going sideways, 3.6 sort of dropped. And then you had this quarter here. This was the start of the whole AI surge we had in 2023. 4.2, and it wasn't just that number, it was the guidance they gave in their presentation, guiding to 100% growth, and they delivered 4.2 to 10.3, and then another roughly 40% growth after that. This is way more than 100% growth, then 40% growth, 14.5. That growth rate has no choice but to moderate, as was pointed out on the recent conference call, that they are guiding to be 30% of the whole global market. How sustainable is it to be 30% of the whole global market? Was an analyst question. That you'll grow to a certain size, and can you be 30% of a market? Well, 14.5 billion. They feel that they can. They feel that the market is going to grow at a rate faster than they can grow into it. But as far as the rest of the segments, it's not there. It's the 14.5, the data center. So why, with this kind of growth, why couldn't it break the $500 mark? If we look at the transcript from the call, this one paragraph over here sort of does it all. It's the last couple of sentences, but we got to read the whole paragraph to understand, to put the last couple sentences in context. On October 17th, 2023, U.S. government announced new and updated licensing requirements effective in our fourth quarter of fiscal 2024 for exports to China and country groups D1, D4, and D5. These are licensing requirements of our products exceeding certain performance thresholds: A100, A800, H100, H800, L4, L40, L40S, and RTX 4090. Licensing requirements also apply to the export of products exceeding certain performance thresholds to a party headquartered in or with an ultimate parent headquartered in country group D5, including China. October 23rd, U.S. government informed us the licensing requirements were effective immediately for shipments of our A100, A800, H100, H800 and L40S products. Those are their GPUs. That's data center. That is that whole category for data centers. These licensing requirements did not have a meaningful impact on our revenue in the third quarter of fiscal 2024, as they were announced near the end of the fiscal quarter, and we had additional demand from customers outside the named country groups. Our sales to China and other affected destinations derived from products that are now subject to licensing requirements have consistently contributed approximately 20 to 25% of data center revenue over the past few quarters. Let's just let that sink in a little bit and reread that so we don't miss that. Our sales to China and affected destinations derived from products that are now subject to licensing requirements have consistently contributed approximately 20 to 25% of data center revenue over the past few quarters. And looking at the revenue trend, as I said, if you take out the data centers and look at the other segments, you'd say, yeah. But data center, that's NVIDIA. That's the NVIDIA story, 20 to 25%. Last sentence, we expect that our sales to these destinations will decline significantly in the fourth quarter of fiscal 2024, though we believe the decline will be more than offset by strong growth in other regions. In that sentence, we have a fact and a hope. The fact is they expect their sales to decline significantly to those destinations. And the first part of the paragraph that we read, all of this lays out the reason why, and it's pretty clear that, yeah, it's going to be tough to get around that. The second part is the hope. We believe it'll be more than offset by strong growth in other regions. So don't worry, growth in other regions will take care of it. Now, they are trying to make lower powered versions of those GPUs that fall below the performance requirements to sell into China, and last week they announced that that is going to be delayed, that it is not going to be ready for when they said it was going to be ready, so that explains the price drop last week. It would seem caution is warranted before getting into NVIDIA thinking there is the $500 plus area that the stock could get into until there's more clarity on whether or not it can produce a chip that is below the performance requirements for them, and probably to see did the hope show up? Was there strong growth in other regions? They spent a lot of time on the conference call really pushing that idea, and they kept bringing back the example of India, how much India is adding, and the capacity that the Indian government is going to add. And if it seemed to just be left there that if they're doing that, then think about all the other governments that'll do something as well. So I think that NVIDIA probably is going to be challenged at that $500 level until they can probably demonstrate something. But again, if we go back to the revenue trends, the NVIDIA story has been a data center story, and it has been a story. You can't argue with that. 3.6 to 4.2 to 10.3 to 14.5. But 20 to 25%. It says consistently for the last few quarters, it's been those affected areas, 20 to 25%. So you're looking at about 3.5 billion of the 14.5 billion are going to be affected. Can it make up that 3.5 billion from growth in other parts of the world? Now, if it can produce flat quarter-over-quarter data center revenue, right? If the rest of the world is growing 20 to 25% quarter-over-quarter, and their sales are going to be impacted by 20 to 25% by the affected areas, you'd have to get that growth just to have flat revenue quarter-over-quarter, which is zero growth in revenues quarter-over-quarter. Yeah, I think $500 is going to be a tough line for NVIDIA to cross until it starts showing that the rest of the world is growing faster than those affected areas. Forward multiple on SPY sitting at 19.44. It was 19.24 last week, so 0.2 more on the multiple. And we got there with a combination of a higher closing on the SPX. Last week was 45.14, and slightly lower earnings. 235.95 to 235.82, down 13 cents. That's IBES. And a drop of 20 cents from SP Global. Call that flat. The thing that I can point to is that we don't have the opposite. We don't have a ratcheting up of earnings estimates week after week like we would after a significant contraction and we're in the early stages of recovery. Earnings expectations are usually moving up at a very healthy clip. These are flat to down, and every week earnings expectations are down. They're not cratering, but they're down, which is just the wrong direction to continually support multiple expansion. 19.44. SPX right now sitting just below the July high. Another 40 points on the SPX to take out the July high. It is above the 50-day moving average, which is over here, above the 200-day moving average, which is here, and significantly above the 50 and the 200. Several standard deviations, at least 2 standard deviations above, because this is sitting at, what, 426? And if you look at where implied volatility is, it is non-existent, sitting even lower than where it was during this period of time where, I don't know if you recall, but there was some talk about AI. And there was some talk about AI, and there was more talk about AI. There was even more talk about it, and even more talk about it, and even more talk about it. You remember that? And up the market went, and down implied volatility. We're even lower than that now. Look at this, just rocketed straight up, all on an interest rate, decreasing inflation and interest rate pause story. I think the interest rate pause is it's in the market. So unless you actually start getting cuts now, I don't know how you can continually justify an increasing multiple on a market where you're not getting cuts, where you're just going sideways. But 19.5, and each week it just inches up a little bit. 40 points away from that July high. I'm just not seeing it. I don't know, and even if we do, just for fun's sake, print above 4,600, the question is, can we push meaningfully above 46 and stay there? To do that, that multiple is going to have to go to 20 and 21 to push meaningfully above it and stay there, because I'm not seeing that earnings are being ratcheted up and coming along for the ride. We don't really have too many earnings left. This week we have Dollar Tree and Salesforce. On Wednesday and Thursday we have Kroger and the health of the consumer out of Dollar Tree on this one here. So it's really the economic calendar from here to the end of the year to determine whether or not we can rally to 46 and stay above 46. Where is the risk? The risk is not in earnings at this point. The risk is in the economic data. The Fed is on the 13th, but we have some crocodile-infested moats to cross before we get there. We have PCE this week, which I expect to follow CPI. It usually does. I expect it to be benign. You have the jobs on the 8th, CPI on the 12th, and then you have the Fed on the 13th, where I expect no move whatsoever. And then from there, you have basically open skies till the end of the year. There's no more significant economic data. There are no more earnings. There's always the randomness of endogenous events, geopolitical events, things like that. And the only real event there is tax loss harvesting into the end of the year. But the markets are up. Equity markets are up this year, which means tax loss harvesting will be rather benign. It won't have as big an effect as if the markets were down and people are sitting on losses. It's like, well, then let's take these for tax purposes. But if we can get neatly past PCE, jobs, and CPI over the next 2 weeks, and we get zero over here, and these come in friendly, we could get that Santa Claus rally and have a close above 4,600 by the end of the year. But I think as you push towards 46, the focus will be over here saying, if only earnings could come along, if you had earnings expansion, and all of this came in good, and you got nothing from the Fed on the 13th, and you had earnings expansion, I would then say, yeah, it looks like 4,600 plus is very much in play. Right now, it would be in play only from, I think, a behavioral perspective. I don't think from a fundamental perspective. But I have been mostly wrong on beta all year long, so don't listen to me. The market could finish at 5,100 and trade at 22 times earnings going into 2024. That would not surprise me given how the market has behaved this year. Anyways, that's it for this week. Oh, reminder, if you have the Applied series, there are 2 live Q&A events on the site today, one from noon to 1:30, and another one 9 p.m. this evening. So if you have the Applied series and you have questions, that's where you show up.